Welcome to the Capital News. I'm your host, Alex Karitis. Today is Tuesday, March 2nd, 2021. Thank you so much for joining me. The title of today's podcast, Market Bubble Blame Game. The focus of today's conversation is going to be on recent comments by a major Chinese regulator, starting to point the finger, starting to lay out the narrative and the groundwork here for the blame game with these markets globally being in bubble territory. So this is somewhat a shot across the bow. It's going to be interesting to see how other countries and other regulators and other central bankers respond to this commentary by the Chinese regulator. Obviously, we're going to see in a couple weeks' time the Federal Reserve have and obviously conclude their FOMC meeting for the month of March. I hope this question is raised. There's going to be a ton of questions of interest for the Fed's meeting in a couple of weeks with respect to the current increase in yields here across here in the Treasury market and also global bond markets, and questions about potential yield curve control, questions about other tools that the Federal Reserve might claim that they have at their disposal for perhaps interest on excess reserves which exist within banks, how they might tweak that, how they might amend their stance with respect to quantitative easing. Right now, I guess we can say they're on somewhat autopilot of $120 billion per month to purchase treasuries and mortgage-backed securities. So there might be some changes to those things. Or it could just be, okay, everything's fine, it's just going to be wait and see. And then if there's a tantrum within the market, then they'll come back and they'll say something in April, May, whatever. Okay? So there's a lot of unknowns that exist out there as to how these central authorities are going to play the game, but that's what we're looking for. They are out of tools. I don't care what they tell us. They're done. They are in panic mode. We know this because we have various large central banks around the globe who panicked last week when yields started to go up a lot faster than what I guess they were expecting. With the Reserve Bank of Australia throwing $2 billion in last week, throwing in $4 billion this week already to get control of their debt markets. The ECB coming out, making statements that they stand at the ready to push yields lower if they have to. And they're going to have to. And then you have central bank here in the United States, the Federal Reserve, coming out through various mouthpieces, governors on the board of the Fed, other presidents within the Federal Reserve System, coming out and saying, oh, well, this is okay. This is perfectly okay. Actually, it's what we want to see because this is indicative of growth. So the central bank gang didn't get together on this one to sort of have a one-voice narrative as to how they are going to explain and rationalize this increase in global yields. And of course, as we've witnessed over the past couple of days here in the U.S. Treasury market with respect to the 10-year note anyway, there hasn't been much movement at all, which of course is somewhat of a head-scratcher because we've been seeing a lot of movement, a considerable amount of volatility in the Treasury market. And again, we're focusing here on the 10-year note. So for it to sort of level off over the past 2 days it's a head-scratcher, isn't it? Not much movement. I wonder who has enough power and authority to do such a thing. Could it be the Federal Reserve? Because the Federal Reserve does have a trading desk out of their New York office. Did you know that? That's how all of this crap gets done. That's how all of this stuff gets handled. Monetary measures, those presentations, those capital economics presentations that we have posted at thecapitalnews.com and our YouTube channel, that gets done by the Federal Reserve. They have a trading desk. All that bond buying, all those mortgage-backed securities that contribute to their exponential growth to their balance sheet, to the explosion in M1 and M2 money stock. That's where that takes place. This doesn't just happen, in some sort of fairy tale setting. This is reality. So the point, obviously, of today's discussion is to see how central banks and federal governments come out in response to what China said. Because make no mistake about it, the United States and China are engaged in economic warfare. Both of these countries, their respective financial markets and various financial assets are in bubble territory. They have been for a while. They are just getting more and more extreme by the day. The Chinese regulator even called out the Chinese real estate market as potentially being in a bubble. But we'll get to that. We'll read a brief article from the Financial Times highlighting some of his comments and how it sort of breaks down. But this is just trying to get ahead of the curve, getting ahead of the inevitability of some sort of market correction. And of course, that's what we would expect to see as a market correction, is market forces increasing yields. Because absent all of the monetary shenanigans and fiscal shenanigans that have been taking place here for quite a long time, and on overdrive over the past year and a half, interest rates should be much higher. That is what a free market would have exist right now. Because those higher interest rates would serve obviously as a hurdle rate to borrow money, and it would also start to flush out the system with all of the malinvestment. There would be a lot of liquidations, there would be a lot of bankruptcies, there would be a lot of that waste that has been built up into the system. It would start to get liquidated away, and that's exactly what has to happen. That's why I'm saying, folks, there is no easy way out of the mess that we have created. But politicians, bureaucrats, central bankers don't want to be on the hook when it all comes tumbling down. So they continue to do what they have done and have been doing, which caused the mess in the first place. So when we talk about zombie corporations, all U.S. corporations, small, mid, and large companies, this is why they exist. Because of lower interest rates that should not exist. But they do because of artificial stimulus, artificial measures from the federal government, from the central bank. And this is happening everywhere. This is not just something that is unique to the United States of America. Pick a country, any country, they're all basically doing the same thing, unless they are already in a situation where they have runaway inflation. And to mention that, a good little segue here for Turkey, because we have Turkey inflation rate continues to rise. Consumer prices in Turkey jumped 15.61% year on year in February, above 14.97% in January, and above market forecast, which we're projecting 15.39%. So 15.61% increase to the inflation rate for consumer prices in Turkey. Now, Turkish producer inflation is at a 21-month high of 27.09%. Okay, so is this the world we want to live in? You think that this cannot happen here in the United States of America? Oh, it can. It can, and if we continue on this path, it will. We are not immune to this stuff. I'm talking about this since 2019, since this podcast has been online. All of the protests, the riots, the discontent with these governments, the collapsing of various societies and economies. Said, well, just wait. The weakest links are going to go first. And it will make its way here to the United States. And lo and behold, it did, it has, and it will continue to do so. What gives us a little bit more breathing room is obviously we are the world's superpower. We have the world's reserve currency. We have an extremely powerful military. And we have a diverse economy. That buys us time. But a lot of the policies that we are implementing get spread across the rest of the globe. So these are not just one-off. So being in that position of power gives us more time, but we are causing a lot of problems for other countries around the world. And of course, those are going to have downstream effects, and those are going to boomerang and hit us as well. They already are. They will continue to do so. And if we continue down this path of passing, $1.9 trillion here, a few $100 billion here, a few $100 billion more there, it's going to reverberate, and it's going to prove very destructive and devastating. Okay, we are a first world banana republic. Ask Zimbabwe how they're operating. Ask Lebanon. Ask Syria. Ask Venezuela. Ask Turkey how they're coping. And you can pick a handful of other countries around too. Peru, Ecuador, Argentina. There's a lot of weakness out there. And you can say, okay, yeah, a one-off here or there, a couple countries, no big deal. When it starts to become several, it starts to snowball. It starts to pick up steam, starts to build momentum, and it's going to start bringing other larger economies down with it. Make no mistake, these central bankers understand this. A lot of governments, I think, frankly, understand this too. But again, there's no leadership, there's no responsibility, no accountability, because this is going to reveal their level of incompetence and dereliction of duty. And that's a good segue for another thing I want to briefly talk about today too, is infrastructure, because we can almost bet with 100% accuracy here that Congress is going to attempt, at the very least, to push through an infrastructure spending bill sometime this year. The question is, how big will it be? And we have the American Society of Civil Engineers out with their once every 4-year report card for U.S. infrastructure, and we have earned a grade of a C-. That is a slight improvement over the 2017 grade of D+. We'll have to get into that report when it's more fully available, but C- nonetheless is thus far the grade for their 2021 report. Now, that to me is inexcusable, but that's just further proof positive of that dereliction of duty and the level of incompetence that exists within state, local, and our federal government. They just do not want to handle the real issues. Infrastructure is needed. Infrastructure is an investment. And I'm going to read a report that came out from the American Society of Civil Engineers last summer talking about some of the impacts that COVID-19 has had on infrastructure, some of their cost-benefit analysis, some of the projections of what a poor infrastructure will cost the average household. And these numbers are, of course, devastating. And we'll get to that momentarily as well. But the reason why so much infrastructure is neglected is because so much of it is not seen by the vast majority of people. Most people don't drive by or live by levees and dams and anything, obviously, that is underground, a whole bunch of pipes. It's never seen. It's never seen. But so it's not sexy, it's not glamorous, it's not eye-catching. There's not a lot of ribbon-cutting ceremonies for a bunch of politicians to come out and say, look what I did for you, folks. See what we're doing? It just doesn't, it's, again, like we talked about yesterday, it's not politically expedient. And if somebody has been a politician in a locality, a municipality, state, federal, it doesn't matter, and you start to realize how expensive these projects cost, people start to connect the dots. They say, why does it cost so much? Have you really been neglecting it that much? And they say, well, we're paying all of this money. Where's all my tax dollars going? So it starts to lift the veil. Pay no attention to the man behind the curtain, right? That's what this is. This is revealing how mismanaged our economy and our politicians are and have been behaving with respect to the economy, infrastructure, and everything else under the sun. Because obviously you're going to have different projections as to what it's going to cost us to improve our infrastructure from, say, a C- to a B+ or an A-. Okay, the American Society of Civil Engineers might say, well, that's going to cost us about $5 trillion. That's a huge number. For context, we bring in about $3.5 trillion in tax revenue. That's across the board. Okay, and we're talking about $5 trillion perhaps to get us up to somewhere where you would think would be acceptable for what's supposed to be the best country on the planet, right? So we're already in a deficit off the bat, with our largest buckets being Medicare, Medicaid, Social Security, our defense budget, and interest payments on our national debt. And we're already running a few $100 billion deficit just from that, not including all of the other welfare and transfer payments and the other departments of government that need to be funded. Well, they don't need to be, but you understand. They're there. Now, the ASCE is going to have that projection, say it's $5 trillion, but then you're obviously going to have other authorities within those respective states and municipalities that say, well, yeah, those engineers might claim that it's going to cost $100 billion to fix our airports, but we think it's going to cost $50 billion. So who's right? Right? At the end of the day, who's right? They both maybe have their incentives, maybe these engineers at the ASCE have an incentive to say, yeah, we want it to be very costly because we want to be the ones who design, maintain, and build these structures, and we get paid more if there's a higher price tag. So maybe that incentive structure is there for them. And then some of these governmental agencies who are saying, no, it's less than that, well, they want to make it seem like we have things under control. Yes, it's going to be expensive, but not that expensive, because they don't want to reveal their level of incompetence and their dereliction of duty. Okay, so of course, time will tell all as to how much this is going to cost us to get infrastructure to where it should be in what is supposed to be the greatest country on planet Earth. And we're going to see what the Biden administration and the Democrats, and I'm sure Republicans will get on board with some of this too, to spend more money that we don't have. The sad thing is it's needed. It's needed. And I guess the only good blessing in disguise that we have at this juncture, at least for the time being, is we have low interest rates. So our borrowing costs are low. So you want to lock it in, now's the time to do it. Because if the market has its way with us, and I think we might be at that crossroads, then our borrowing costs could get out of hand very quickly. And when you're talking about, which we did hit $28 trillion, by the way, in our national debt, congratulations, everybody, pop the champagne, $28 trillion hit today. It doesn't take that big of an increase in interest rates to really start increasing the level of payments that we have to make to service that debt, which, of course, is why central banks the world over are panicked, because they understand this. Again, compounding interest in time can work for us or it can work against us. It's pretty easy to understand. Here's some market performance. Dollar index at 90.69, so still flirting with where we were yesterday. Not a lot of movement right now as currencies trade overnight. Bitcoin is at $49,900 a coin, so pretty close once again to that $50,000 figure. Psychological number, we'll see what happens. Overnight futures trading, the Dow Jones is up about 0.6%. The S&P 500 is up 0.7%. NASDAQ 100 gaining about 0.9%. The markets were down across the board today on Wall Street. Japanese cash trade put on a gain of 0.6%. See a green across the board across the pond in Europe today. Australian cash trade put on a gain of 0.8%. Chinese stocks rallied strongly today, putting on a gain of about 2 percentage points. On the share price front here in the U.S., Apple gave back 2%. Tesla lost 4.5%, trading at $686 a share. Microsoft giving back 1.33%. Amazon giving back 1.23%. And to round it out, Facebook gave back 2.25% for the day. On the commodity front, WTI is trading at $59.95 a barrel, Brent at $62.94, natural gas $2.87. Gold and silver hanging on, still weak. Gold at $1,734 an ounce, silver $26.75, copper hanging on at $4.20 a pound. And as we stated previously, Uncle Sam's 10-year junk note hanging on at 1.41%. So not a lot of movement there. This is, of course, I think, Federal Reserve targeting the 10-year, trying to keep it under control to sort of allay any of the fears that are propping up within the stock market, because that's who they're working for. It's to keep asset prices higher. It's an economic war with China. None of these countries want to be the one that has their bubble pop first. Okay, so the blame game, that groundwork is starting to be set up. Okay, it's just what's going on, as far as I'm concerned. Could be wrong about that, but I think that's what's happening. So here briefly is this short report from the American Society of Civil Engineers. Again, this came out last summer. So here we have, let me just see where I want to start this here, because this is really what I just want to mention. So this is according to the president of the ASCE. So each American household was already losing at least $3,400 each year in disposable income due to poor and outdated roads, bridges, electric grid, water systems, and more systems that are critical to the public's health, safety, and welfare. $3,400. Imagine what the average household could do with an additional $3,400 in their pocket. Well, we know, because we go through these numbers all the time, we know that a significant portion of this country could not come up with $400 in the event of an emergency. So $3,400 could be life-changing to millions of Americans and families. So, and of course, they're coming up with this number most likely from the amount of time that is lost, spent in traffic, the amount of damage that might be done to your vehicle that otherwise wouldn't happen if you had better roads and bridges and better infrastructure, if you had a more efficient electric grid, because a lot of energy is lost during transmission. So if we had something that was more efficient, more stable, then you might be paying a lower utility bill, etc., etc. You get the point. Okay? So that's a lot of money, $3,400 per household. And obviously the report continues with some of the ideas that these engineers have for Congress, throwing some of these things into a bill within the House of Representatives. Of course, this was last year, so we'll see if this gets any traction as we make our way through 2021. A couple other estimates that was put forth in this report. An estimated $23.3 billion loss in airport revenue due to a 95% decline in domestic air travel, obviously because of COVID-19. A projected 30% revenue decline in the next 18 months for the nation's state departments of transportations, approximately 17% loss in annualized revenue in the drinking water sector, including more than $5 billion in losses related to suspending water service disconnections and increased customer delinquencies. Dramatic nationwide ridership declines in transit systems, 75% decrease on the PATH commuter rail system in New Jersey and New York, 85% reduction in Washington, D.C. metro rail ridership, and a 55% decrease in ridership on Los Angeles Metro. So there have obviously been some huge impacts with respect to transportation and obviously a loss of revenue across these various departments across the country. So how is that going to be made up? Well, you guessed it. I mean, Congress is going to pass more spending. We don't have it. We're going to borrow it. We're going to beg for it. We're going to have a central bank that prints it. And that's going to be the end of the story. And the other side of that coin is, of course, your taxes are going up too, because you cannot continue on this path forever. And if you can, then there needs to be an open conversation and discussion that could take place as early as a couple weeks with Jay Powell, the chair of the Federal Reserve. Once they conclude the FOMC meeting, we can simply ask, if you're just going to print money to solve all of our problems, what's the point in having a stock market or a bond market, or any other type of market for that matter, if all of these prices, if bond prices are only supposed to go up, if stock prices are only supposed to go up, then screw it. Why have all of this infrastructure and all of these people dilly-dallying in these markets when you can just give us the money? Just link us up, our bank account, to the Federal Reserve, and boom, give us what we need. Just give us what we need. Some people need more, so give them more. Other people don't need as much, so don't give them as much. Because at the end of the day, you're just breaking even. That's all we're talking about here. Whatever it costs me to live and what I want to do, just give me that money. Now, that's completely ridiculous, but that's basically what they're doing. Why waste the time playing all these games if you're just going to print money out of nowhere and give it to people in one form or another? Cut out the middleman. Just give it to us directly. Why can't you do that? Ask that question. Get that conversation started, because we don't need taxes either. Okay, we've been all over this for the past couple of years because we saw where this was going. I'm not holding my breath, by the way, with respect to any of these questions being asked by anybody or having any type of serious conversation. But there you have it. That's the American Society of Civil Engineers. We'll get into their 2021 report card again, a grade of C- for the country's infrastructure. That's pathetic. But on to the Financial Times article. China's top bank regulator warns of bubble risks in foreign markets. Excuse my pronunciation of some of these names. But we have China's top banking regulator has warned of the risk of bubbles in international markets and within the country's own real estate sector, in the latest sign of mounting concerns over elevated global asset prices. Financial markets in Europe and the U.S. are out of sync with their economies and fueled by monetary and fiscal policy, Guo Shu-king, chairman of the country's Banking and Insurance Regulatory Commission, said on Tuesday in comments that pointed to a potential spillover into China's financial system. Now, that first statement there, I agree with. Financial markets in Europe and the U.S. are out of sync with their economies and fueled by monetary and fiscal policy. That's true. But that is also a true statement with respect to the Chinese economy. Now, what the chairman also made comment of, and which is also true, is there is potential spillover if those bubbles should pop, which they will eventually, and have potential spillover effects into the Chinese economy and the Chinese financial system. That's true. But the Chinese government, they don't have clean hands on this either. They're a part of one of the biggest smoke and mirror shows on the planet as well. And their bubbles bursting will have spillover effects into U.S. and European markets and economies as well. So this goes both ways, but that's my point. This is China sort of putting out the first notice. It's sort of the blame game. If there's weakness in China, it's not because of China. This will be the Chinese's argument. It's not because of us. We're telling you about bubbles. We're trying to tighten some standards. We're trying to rein in some of these excesses. So if something bad happens to us here in China, it's because of those damn Europeans and Americans who are trying to live well above their means. Okay? This is setting the groundwork for what's likely coming. Quote, I'm worried the bubble problem in foreign financial markets will one day pop, he said. China's market is now highly linked to foreign markets and foreign capital continues to flow in, end quote. The stark warning followed large inflows into China on the back of its rapid recovery from the pandemic. I don't buy that rapid recovery rhetoric. And as authorities in Beijing sought to liberalize overseas access to the country's tightly controlled financial system. Now, one of the reasons why the Chinese have opened and been more open to opening up their economy is because they know the game that they are playing, and they need to sucker in more suckers and get those capital inflows to sort of cushion their inevitable bursting of their bubble as well. It's a big game, okay? This is all borrowed time. In 2020, foreign direct investment in China was $163 billion, surpassing flows into every other country in the world. Investors piled around $155 billion into the country's capital markets via investment schemes in Hong Kong. So this is why we pay attention and focus on Hong Kong, because they are crucial to the financial hub of Asia and primarily China. So that's why they get so much attention. That's why we focus on them as much as we do. Guo, who is also a party secretary of the central bank, said that the scale and speed of inflows was manageable and added that, on the other hand, cross-border flows should be encouraged, but on the other, causing volatility in the domestic market should be avoided. His comments, which sent equity prices lower across Asia on Tuesday, boosted expectations of monetary tightening in China. The CSI 300 index of the country's biggest Shanghai and Shenzhen listed stocks reached its highest level in February, surpassing its previous peak in the summer of 2000 in the early stages of the global financial crisis. Isn't that lovely? The core problem in the real estate sector is relatively large bubbles, said the chairman on Tuesday. He added that many people were buying houses as speculative assets rather than to live in. Boy, oh boy, doesn't that sound familiar? Haven't learned our lesson. But said that the real estate loan growth had been slower than various other types of lending last year. That really doesn't make any difference. China's debt-to-GDP ratio rose 24 percentage points in 2020 to 270%, its fastest increase since the 2008 global financial crisis, according to HSBC. There you have it, folks. We are awash in debt. It is one bubble economy and one bubble market after the next. It's really the markets. These economies are weak. There's not a lot of, speculative fervor. It's really taking place in the underlying economy. This is in the casinos. These are in various markets, various financial assets. Stocks, bonds, currencies, interest rates. That's where these things are going to blow over. Obviously, real estate, as we're talking here, and that is a global problem as well. Turning these homes and houses into speculative assets like we did just a decade ago. Nobody has learned their lesson, nor do people really care. I guess they're just trying to make hay while the sun's out, is really what this all comes down to. Because when you're awash in all of this liquidity, that money has to find its way somewhere, and people are just responding to that incentive. The problem is more people are going to get hurt than those who benefit from this. And then you have an economist out of HSBC saying that policymakers in China will, quote, naturally pay more attention to the debt risks now that the recovery was well on track, which of course I disagree with, but added that concerns about rising debt levels forcing Beijing to tighten fiscal and monetary policy are overblown. So basically, this economist out of HSBC is saying, yes, the Chinese regulators are somewhat on top of this. They are putting out some warning signals, but don't get overly concerned. They're not going to start tightening. Because that's the only thing that keeps these markets afloat, is loose policies, not tight policies. You understand? So there is going to be a breaking point. I think this, again, is the first move from China to say, okay, look, there are bubbles out there, and if there are spillover effects, if there's any downtrend that happens here in China, well, guess who's to blame for that? Not the Chinese. It's going to be the Europeans and the United States of America. It's always easy to blame it on somebody else. And of course, we're likely going to blame it on some sort of outside force as well, because no politician wants to step up to the plate and be a leader. Nobody wants to be responsible. Nobody wants to take any accountability. So it's always somebody else's fault. And guess who gets to pay for it? You and me. Higher taxes, higher inflation, less prosperity, less growth, less opportunity. You get what you vote for. You get what you pay for. Market bubble, blame game, just getting started. Stay diversified, stay vigilant, and stay with the Capital News. I am Alex Koritis. Godspeed.